Just to be honest with you guys, I'm a little concerned about tomorrow. Here in this video, I will explain exactly why that is and what to expect. Now, we also had some really good Tesla news come out today, about an hour before the end of the trading day, and this is very exciting. Starting today, Tesla is offering a 36-month loan rate of 1.99% APR for all new Model 3 rear-wheel drive and long-range finance orders in the US, down from 6.39%. They are also offering a 4.99% rate for 48 and 60-month finance loans. Orders placed between June 6th and June 16th are eligible. Model 3 Performance does not get this promotional rate. Now, I show you guys the Google Trends data in almost every video that comes out every day at 4 p.m. sharp here on the channel, and you did see a large uptick in search trend activity for the Model Y when Tesla offered the 1% financing rate. On Google Trends, you went from 21 for your Google Trends number, March 10th through the 16th, all the way up to a high of 49 by May 12th through the 18th. It looks like this really did spark a lot of sales over at Tesla. And although Tesla does have to buy down the interest rate, so it's costing Tesla money, it's a lot better at boosting demand than just cutting prices. And this is by far a better strategy than what Tesla has been doing in the past. The problem was not Tesla was cutting prices necessarily. Tesla was cutting prices, but it was not boosting demand or deliveries. This seems to boost demand. So I do think that is very exciting and the right move for Tesla. I also think it's pretty exciting that Tesla has launched the Tesla Mezcal in the US for $450. It is another fifth of tequila. And we're probably going to take a shot here, a shot there when important events happen or if Tesla's stock starts to do well. Although I'm really not a big fan of opening specific specialty, liquors, tequila for that matter, like this one, Detroit Lions 90th anniversary, 90th season anniversary. This came out last year, still unopened. People are like shocked that I haven't opened it. It's gonna sit here. It's gonna have to be a major event to crack open that Tesla tequila, but I think we're going to get a lot of major events over the next 12 months. I think Tesla's stock could be well into the 300s, if not all-time highs, a year from now if things continue to go at the current trajectory. Elon Musk's comp package does get reinstated. I think on June 13th alone, you could see a 20+% day. After all, we talked about this in one of the last videos, but Tesla's stock to start 2024 was about $265 per share. Now, what happened is the judge in Delaware shot down Elon's comp package, and there was a lot of fears of that. So what happened? Tesla stock sold off from 265 down to the 210, 215 level, and then really sold off after the judge said his comp package was basically null and void. And that's had a very negative impact to Tesla stock that I don't even think a lot of people understand because it's already priced into Tesla, and that is a reason why Tesla is where it is today. I mean, if you consider Elon Musk is 25%, let's say, of the value of Tesla, or an extra 25% of the premium in Tesla's valuation, and there's doubts that Elon may leave Tesla, even if you don't think so, Wall Street does, and that's the problem. There has been doubts that Elon might leave Tesla. Then if that gets resolved on June 13th, I really don't find it, illogical. Tesla couldn't go back to the mid-high 200s, if not the 300s, especially considering we're closer than ever to getting rate cuts. Now, the problem is whether or not the economy can hold up. I made this post on X last night and said, I'm pretty bullish, but I fully understand not all rate cuts are good for stocks. Historically, the S&P 500 sells off 20% on the first cut. If the Fed comes out on June 12th and signals the first cut coming July 31st, we may actually avoid a recession and cut rates, quote, soon enough. Usually the Fed cuts rates because they're too late. Something is going wrong. Something is breaking in the economy. If we can do what the Bank of Canada or the ECB just did today, cutting rates, then we're going to be in a much better place rather than if we start to get bad data. And yes, I should mention the ECB did cut rates today, this morning, for the first time since 2019. That follows Canada cutting rates yesterday. And what this does is it means your developed nations like Europe and Canada and other parts of the world, well, now they're looking at US bonds sitting at higher yields than their own bonds or that country's bonds or this country's bonds. And it makes the US bond market look a little bit more attractive because who wouldn't want to invest in America and buy bonds at, let's say, 4.25% if you're a Canadian and your bonds are 3.7%, or if you're a European and your bonds are 3.5%. I'm just making up numbers here. I don't have them off the top of my head, but you would much rather go for the US bonds giving you a higher yield. And when there is buying pressure in the bond market, that pushes up bond prices and that pushes down the yield. And you didn't see yields do much of anything today, but they have fallen over 30 basis points, about 36 basis points or so, in just the last week. Now, some of that, maybe half of that, was because Canada and the ECB cut rates over the past 2 days. And the other half is because people are fearful that the economy is going to get worse and go into a recession. And that's basically the best thing you can do if you're someone with a lot of money and rates are 4+% and bonds have been suppressed or depressed for many years. One of the best investments you could make to hedge out a portfolio or protect your capital would be to buy bonds, because what's the Fed going to do? They're going to cut rates, bond yields are going to fall, bond prices, as you can see here on TLT, are going to go higher. So basically, bonds are a flight to safety. You've seen a little bit of a flight to safety in the past week or so. And I am concerned that this Friday, coming tomorrow, in about 14 hours, 16 hours or so from now, you could see a real panic start on Wall Street. So tomorrow we are going to get the non-farm payrolls report. Wall Street is expecting about 185,000 jobs were created in the month of May. Last month you came in at 175,000. So this number that we get tomorrow will be important. But what will also be important is last month's number. There will be a revision to last month, higher or lower. Now, normally in the last year or so, almost every revision we have seen has been lower. The question is how much lower, because we get this first number and, we think it's a certain number, and then sometimes you can get a 50,000, 60,000 downward revision. Let me tell you, I think that could be the most important part of tomorrow is actually the revision. Because let's say, just for shits and giggles, let's say you come in at 185,000 jobs for the month of May. Great. Looks like the economy is doing okay. That should be great news for stocks. Since, again, the last couple of days or 2 weeks or so, we've been selling off because it looks like, the economy is weakening. And that's never a good thing for markets. Okay, fine. That's one thing. Great. But let's say you come in with a 75,000 job revision for last month, and now you're sitting at 100,000 jobs for the month of April. Wall Street's probably not going to like that at all. In fact, that may actually start a panic on Wall Street that we are heading into a recession, and really nobody's expecting that. And that's why tomorrow is so important. Now, on Wednesday, we had our ADP employment change. Now, what is that? Well, that is the private jobs number that's not done by the government. And there were a little bit of problematic, I guess, if you will, warning signs for tomorrow's non-farm payrolls report. Now, private businesses in the US added 152,000 workers to their payrolls in May of 2024. Most of these jobs were in the service providing sector, adding 149,000 jobs, mostly trade, transportation, and utilities, up 26,000, education and health services, up 46,000, financial activities, up 28,000, and leisure and hospitality, up 12,000. That's it. Now, a lot of the past jobs reports that we have gotten from the BLS, that is tomorrow's jobs report, the government jobs report, one of the top categories of that report for years now has been leisure and hospitality. The fact that you barely came in positive on the ADP in this report, this jobs number, is a bad sign for tomorrow, because if we did not add that much jobs to leisure and hospitality, it's going to be very hard to even meet consensus on the jobs number. So odds are you're going to miss 185,000. The question is, by how much? Are we going to miss by 50,000, or are we going to miss by 10,000 or 20,000? Personally, I think any number that is higher than 150 is going to be seen as good news, and probably the higher the better. I think the markets are over with the whole weakening of the labor market to see cuts from the Fed, right? The focus has shifted to good news is good news and bad news is bad news. The Fed's going to cut rates regardless. We just want to avoid a recession. That's kind of what the markets are saying. So any number higher than like 150,000 jobs is probably going to be taken as good news. Any number lower than that is probably going to be taken as bad news. And I think you outright get a panic if you're around 100,000, or God forbid, even lower than 100,000 jobs tomorrow. Like if you come in at, say, 80,000 jobs tomorrow, and last month is revised down to 100,000, again, this is not my expectation, but if that were to happen, I would strongly expect the NASDAQ, the S&P, the Dow, and the Russell could sell off anywhere from 2.5% to 5%, because nobody's expecting that. And again, there are some signs that maybe we should start expecting some really weak numbers, and maybe that could start tomorrow. Now, we did get the initial jobless claims as well today, as I mentioned in the last video. They didn't come in, that bad. They came in at 229,000. The estimate was 220,000, but for so long we were missing to the downside on initial jobless claims. People were starting to expect, hey, this is going to be the week that initial jobless claims go higher. Never was. Well, now over the past couple of weeks, you have actually started to come in a little bit on the higher side. Now, again, 229,000, that's not a panic level, right? But it's not a good sign heading into tomorrow either. Now, the other part of tomorrow is going to be the unemployment rate. Now, we did tick up last month from 3.8% to 3.9%. But if you break into the 4% range, then that's a, different kind of environment, right? You have not broken into 4% or been above 4% since January of 2022. Even during 2022, when everyone's expectation was, we're going to have this recession. It's, recession's coming, blah, blah, blah. You still were under 4% unemployment. So if unemployment does hit 4%, that could spark a little bit of panic as well, let alone a 4.1% number, which I don't think is out of the realms of possible. Not at all. Another potentially concerning part about tomorrow is Nvidia. Now, Nvidia was down 2.25% today. Today was the record date for the stock split. So like a dividend, right? You got to own the stock up to a certain day to be eligible for the stock split, right? So today is that day. Now, what does that mean? Well, anyone that continues to hold their Nvidia, they're going to be eligible for the stock split throughout the day today. Now, coming tomorrow in after hours, that is when the split will actually happen. And then the stock Nvidia will start trading at roughly $120 per share or so coming Monday morning. Okay. What you've seen today, the sell-off that you've seen, was mainly a lot of traders that are like, hey, I was just trading this after Nvidia earnings. I am going to sell out now because I really don't want to hold this stock and I don't want to go through the whole split, right? So that's a lot of what you've seen today. Fine. Coming tomorrow, and especially on Monday, is when you could see a lot more selling. And especially after the kind of rally that Nvidia has seen following their earnings, it wouldn't surprise me. Nvidia normally sells off before or after earnings. This time, it didn't happen. You didn't get any sell-off in Nvidia before their earnings or after their earnings. If anything, Nvidia rallied $200 into earnings and then continued to rally from there, effectively going up, almost $500 per share since the lows that you hit just back April 19th, about less than a month and a half ago. You're due for some kind of large and sharp correction to the downside, and that will not do the markets any favors. Coming tomorrow, again, if the data is kind of recessionary, or if the next, maybe week or two could also be negative, Nvidia selling off is just going to be an even bigger negative. Now, Bank of America said sell-side indicators at levels suggesting the S&P 500 has the potential to advance 13% over the coming 12 months with a 94% positivity rate. Goldman sees a wall of money fueling stock market's summer rally. And they say since 1928, the first 15 days of July have been the best 2-week trading periods of the year for equities, and they tend to fade after July 17th. Says the S&P 500 index has been positive for 9 straight Julys, posting an average return of 3.7%. The NASDAQ 100 has an even better record, posting gains in 16 straight Julys with an average return of 4.6%. So there are a lot of people that are bullish out there. There's a lot of data that would suggest the rest of this year could be very bullish. And as a contrarian by nature, I get a little nervous when everyone is this bullish. I mean, people are going on CNBC, Yahoo Finance, Bloomberg, and all of these other financial, media outlets, and saying that Nvidia is cheap, that it's a good deal, that the growth's going to last forever. Nvidia is a cyclical business. If companies that are spending billions or tens of billions of dollars on Nvidia GPUs do not make products that can generate them any kind of return, at the first sign of economic problems, recession coming, the first thing that's going to be cut is the, GPU budget, because odds are a lot of these companies already have all of the GPUs that they need, like Amazon, like Tesla, and I'm sure there's many more. And trust me, I believe in AI probably more than you do, more than the next guy. I have a very crazy outlook for what the next 50 years could look like for society, like a Jetsons type of world, right? And all of that's going to be powered by Nvidia. I get it. Yes, there's a lot of reasons to be bullish over the long term, but it is very important when you buy a company. And I mean, you've ran so hard. We haven't even had a bad quarter yet. There will be a bad quarter over the next 4, 5, 6, 7, 8 quarters. It will happen. And none of that's priced into Nvidia today. In fact, Mark Stevens, the second largest Nvidia shareholder and board member since 2008, just sold another $4 million worth of Nvidia. He's now sold more than $40 million in the stock in just the past week. There's a lot of reasons people sell stock. They want to buy a boat, they're getting divorced, they're getting married, for their kids' education, to buy their kids a home. Vacations, doesn't matter. There's a lot of reasons to sell a stock. Not necessarily super problematic, but he is selling into all-time highs. It definitely doesn't look good. Here you have Bank of America that says bears looking through the wrong end of the telescope. The market narrative has grown very short-sighted, where recent softness in macro data is cause for alarm. But zoom out, trends are normalizing and are healthy versus long-term history. And this is just trying to justify bad data, data getting worse. And I just don't agree with that. Sure, there's normalization happening. There's the long-term history aspect of this. But when does it change from this is normalizing to, oh crap, things are bad? The way that stocks are right now, the way that broad markets are, there is no recession anytime soon. Even if there is or isn't. I think the risk is elevated. And that does lead me to be a little bit concerned about tomorrow because, again, I don't think it's priced in. And this is one of the craziest posts that you're going to see today. While everyone says the markets are broadening out, things are great or okay out there, whatever people say on CNBC, just go on CNBC and there's going to be a lot of people that are bullish on CNBC, money managers. The data doesn't lie. The average stock's distance from 52-week highs, you're not even going to believe these numbers. The S&P 500, the average stock is still down 12.3%. Wow. Especially, in the S&P, it's the worst for consumer staples. That's the worst sector. The Russell 2000, 28.3%. So let's get this straight. The average stock in the Russell 2000 is down almost 30% from all-time highs. That is the average stock, let alone the worst, right? Or the worst quartile. That's rough. Now, the S&P 500 tech stocks, same is true there. The average stock down about 12.3%. The Russell 2000 tech stocks are down 30.8% on average. That is crazy. And you can see healthcare within the Russell 2000 is down almost 40% from its 52-week highs. Communication services down 31.4%. Consumer discretionary down 30%. Technology down almost 31%. Just insane numbers. So I do believe for better or for worse coming tomorrow, especially if we come in with a decent number and Wall Street likes it, you're probably going to see a vast majority of the gains in small caps, in Joe Schmo average stocks, especially as Nvidia sells off. As you've seen today, that was a big positive for other stocks. PayPal, Tesla, Square. I mean, so many other stocks that are medium market cap businesses or large cap companies did well today because Nvidia fell and that money was going into other areas. So long story short, I'm a little concerned about tomorrow. I don't think it's priced in if we get a really bad number. And I don't think Wall Street's ready for that. Now, it would speed up rate cuts, but that would be rate cuts for the wrong reason, and that would not be bullish for markets. So there is a potential to come in with a super low number. Again, you really want to watch the revisions from last month because that's going to be better data. We're going to get this number that comes out, and then we're going to get a new number that's revised. So really, you got to take these numbers when they come out at face value. But that revision, that's going to be a little bit more important. Overall, I am expecting we could see a big day tomorrow. A big day tomorrow to the upside or to the downside. Let me know what you think about this down below in the comment section. Hit the like button as well as subscribe to the channel. You guys have a great rest of your day, and I will see you in the next one.